Hey everyone, welcome back to the Freedom Investor Podcast, where we teach you how to have financial freedom and also freedom through faith. I am here with my man, Beau Brehm from CBRE. Welcome, man.
Hey, Matt. Thanks for having me.
Hey, well, I'm super excited to have you, man, because we've evaluated a few properties, except this time it's not short-term rentals, it's commercial real estate. And you were super insightful on all sorts of different financing structures you can do on these properties. And, I've done some in the past, but like you were the expert. And I know I've got a lot of people listening out there that want to buy commercial real estate, but may not know as much about securing debt and all these different structures out there that they can go secure. And so, honestly, I'm really excited about this conversation. We've got one property we're going to be looking at and evaluating here in a minute. But before we do that, give us a little bit more feedback on your background, and then we can dive into that.
Yeah, sounds great. I'm Beau Brehm. I'm on the debt and structured finance team at CBRE. And what that means is, as Matt said, we work with developers and investors alike that need loans for their commercial real estate ventures. So oftentimes that it looks like people coming to us with their deals, whether it's for an acquisition, a refinance, or a construction situation, and then we work with them to size the deal for a loan, which we'll do here in a minute, and then take it to the market to secure the best quotes the market can offer. My background, I went to Texas A&M. I'm an Aggie with a finance degree. In my former life, I was a college track and field coach, and long story short, decided to put some roots down here in Houston, make a little bit more money than most track coaches do, and so was happy to land here at CBRE.
Awesome, man. Well, very cool. Well, I know you and we evaluated a property in Angleton a couple weeks ago, and it's property I had on the market for a client, and I just wanted to see what that would look like if I had one of my clients or someone else to go purchase that property and see what the profitability would look like if we were to get debt on it, because interest rates are kind of much higher than what they've been in the past. It's hard to make some things pencil. And so now we've got another property that's currently on the market, Northwest Houston, and it's an industrial property. And my understanding from what we've talked about is industrial and multifamily are kind of like your bread and butter. Is that right?
Yeah, I mean, we deal with every asset class. So that's multifamily, industrial, retail, office, or the four major food groups, but self-storage and others as well. I would say certainly investor and lender appetite has definitely leaned towards multifamily and industrial in recent years.
Yeah. No, I mean, that's what I've seen as well. I mean, office side, which I've been an office broker for a long time. It's not many people are buying office right now. Well, you never know. There's some people that are still loving it and want to go scoop it up. But ever since COVID hit,
Everything works at the right price, right?
That's right. If it's the right price, then you go buy it. But I've noticed, like you said, multifamily's been hot for a long time. It's kind of cooled down a little bit, it feels like. But industrial just continues to be very, very hot. Maybe it's cooled down a little bit, but I mean, I'm seeing with my clients, I'm sure you're seeing it as well. It's just continuing to trail up and up and up. And so I'm really excited today because we have a real property we're going to be evaluating that's on the market for sale. It's kind of that sweet spot, location wise and size wise, that a lot of investors are looking for. And so it is a 30,000 square foot building in Northwest Houston. So prime location, kind of that perfect size for a lot of tenants out there. It's crane served, 20-ton crane, fully air conditioned in the warehouse, and then it's got 2 to 3,000 square foot of office and about 3 to 4 acres of lay down yard. And so it's a really great property. It's high demand. We've had a ton of offers and a lot of interest on this property. And so what I would love to do is let's dive into the numbers. If someone, there's a lot of cash buyers out there, but some people can't do cash. And if they wanted to go secure debt on this, I would love to just break this property down, man, and just get your feedback of if I'm the investor wanting to buy this, getting debt on it, what would that process look like and what would the results look like? So I'll add it here and we can go through it.
Let's take a look. So this is a basic underwriting model that we use to evaluate deals for debt. And so this is the light industrial property Matt was referring to. And so the first thing that we oftentimes look at is the rent roll. And so this particular asset is a single tenant industrial tenant. And so going off the information Matt provided, we plugged in the terms of the lease here, the start date, the when it expires. So we get the term as well as what they're paying in rent. My understanding is this is a triple net lease. So that's what that kind of, when I was looking at it, just some of the comments or questions I was going through and looking at it. Do we know what a triple net lease is, Matt?
Well, hey, actually, I'm glad you said that because we know what a triple net lease is, but a lot of clients out there and new people that are trying to get into it may not fully know. So, do you want to explain a little bit more, or me, just so we can
Sure.
give them a
So,
little brief on it?
yeah. So if a tenant signs a lease, that's they're paying rent to occupy the space, but then another part that's negotiable is who's paying the operating expenses, whether that's taxes, insurance, utilities, maintenance, etc. It's common for these industrial deals to have what we call a triple net lease, which is where the tenant fully assumes all of those expenses, which of course is attractive for the landlord because you can count on the tenant paying for that and have some protection if those expenses were to go up. So in this case, we're assuming triple net lease, all expenses 100% reimbursed. So one of the first things I would do is, if I'm working with Matt on this, I would ask him, hey, can we see the lease? Have you seen it? Can we confirm that it reads as a triple net lease? I'd ask Matt about like, hey, I'm seeing it's $1.10 a foot. Is that market rent? How does that stack up with the market rent comps?
Yep.
We
And by the way,
noticed.
on that, as we're going through it, $1.10 is market, and actually it's probably even higher than that now. We actually got in a bidding war on this property with 3 tenants that wanted it at that price, which was our asking price. But rents have probably trended up to $1.15, maybe even a little higher now. So that just a little feedback on that. And then on the triple net side of things, just so investors out there know, um, I personally really love triple net leases or investments, especially these industrial, because you go buy it, you lease it up, it's a 5, 10, 7-year type lease. And you as the investor are basically only responsible for the roof, maybe the parking lot, structure of the building, maybe the facade of the building, like stucco. Other than that, the tenant's really responsible for most everything else. And it's a pretty awesome just cash flow play because especially if you own it without any debt, because it looks like, I mean, you're able to cash flow at least 33,000 bucks a month on it if it's a triple net with no debt. But what we'll get into here in a minute is what that cash flow might look like if you were to put debt on it. But again, that's why triple net leases are so awesome because the tenant is mostly responsible for everything, where the landlord is, hey, roof, structure of the building, and hey, if a tornado hits it or a hurricane hits it, kind of you really don't do a whole lot unless some major events like that happen. So, yeah, sorry, Bo. Yeah, keep going on what you were going through, but I wanted to at least pause there for a second.
Yeah, no, that's good. So then, just a couple other notes. It doesn't necessarily impact how we view it from a debt standpoint, but can be a good selling point for both investor and lender. So the rents increase 3.75% a year. So that's great as the landlord, counting on those rent bumps. And then the tenant has the right to renew for 5 years at fair market value. Lenders like to see, they're going to be concerned with the term of the lease and how that compares to the term of the loan. And they're also, part of that is seeing, what happens when that lease ends. Is the tenant, they're assessing the likelihood that the tenant's going to stick around. And so if they have options to stay, then that improves the odds that they will. And that's kind of, as we shift over to the loan analysis, I'll say that the reasons those are important considerations is because a lender, if you're thinking from their perspective, they're going to be concerned about two things in this situation. Like, they want to know, first of all, as the borrower, are you going to be able to cover the debt service of the loan? And so for you to do that, you need this rent income is what you're counting on to pay that debt service. And then secondly, they want to know that they can get taken out of the loan, that someday you will either sell the asset or you will refinance into another loan, both of which are much more successful endeavors if you have a tenant in the building versus a vacant building, right? So that's, part of the considerations here with just knowing your rent roll, whether it's a single tenant versus multiple tenants. Certainly the fewer number of tenants there are single tenant in this instance, the more scrutiny there will be on their specific situation, both in terms of the lease and the tenant financials. So that's another thing I would be asking about, because the lender, as the broker, my client is you, the investor, but my job is to know what lenders are looking for. And so I would be asking for the tenant financials, because that's what a lender is going to want to see to, have confidence in the tenant and their ability to be a going concern.
Now, are you able to get tenant financials pretty easy, like in a lot of cases, or oftentimes you having to do like NDAs to be able to get the financials?
Yeah, I would say it's not uncommon to have to sign an NDA to get tenant financials. Most of the time you can get them because, tenants, if they've, have any familiarity with commercial real estate and landlords, it's probably a request that's come up in the past, and they understand that that's part of owning a property. So shifting gears here to the loan analysis.
Okay.
And so the first thing we plug in here is I have it here as the annual rent. Usually we're looking at the net operating income, or the NOI. In this case, that's essentially the same thing as the annual rent, since the tenant's paying for all the expenses.
Yeah. And this is year one annual rent is what you're showing.
Yep. And actually I've got it here. So I'm taking the annual rent and then a vacancy factor to get my underwritten net operating income.
And this is something we discussed in the past. You guys on the bank side of things, or the debt side, you're always going to take that 5% vacancy, even if it's fully leased. There's no real risk right now. You just always want to have that buffer.
Yeah. So it's going to be the higher of actual. So if it's a multi-tenant building that has a 15% vacancy, you're going to go with the actual.
Okay.
Or you could be going with the submarket vacancy, but in a 100% leased property, the minimum underwritten vacancy is 5%. That's how lenders are going to view it. That's how the appraiser is going to view it. And so we go ahead and account for that as we're sizing the loan. And so that's, if you notice the cap rate here of 6.18%, my cap rate is going to be different than Matt's cap rate, because we're underwriting some additional factors, just from an analysis standpoint versus the actual cash flow at the property.
Yeah, because our cap rate is 6.5%, but it's bringing it down a little bit just because you are basically reducing the NOI or the net operating income to provide a little bit of a buffer. So the
Right.
cap rate is probably closer to 6% from what the bank is looking at.
Yeah. And so
Gotcha.
if I get rid of this vacancy factor, cap rate 6.5%, like
Yeah.
Matt said. Now, some lenders might take some additional expenses out of NOI. So, for instance, property management, even if the lease has the tenant paying for the property management fee, lenders are thinking risk management, worst case scenario. They're envisioning, themselves having to take over the property and hire a property manager. So, and some of this is just to generally be conservative from their viewpoint, but so
Yeah.
they might additionally underwrite a property management fee, let's say 3%. They might underwrite reserves for some of those items that Matt was referring to, like a
And
parking
take
lot.
that and essentially take that from the NOI.
That's right. Maybe 15 cents a foot. But typically I'll take the vacancy factor. I go ahead and leave off those other items and, wait till someone else penalizes me, so to speak. And this is a pretty basic analysis where you have a single tenant and it's triple net. If you have multiple tenants, or you're not recovering 100% of expenses, then you really need to, do an operating statement analysis to really see, how the historical income and expenses line up with what you're projecting. But we can leave it with this scenario today, but just, as an additional note. So now getting to what many would view as the most important part, how much money can I get from the bank, right?
Yeah.
So that's the essence of sizing a loan is what is this loan amount going to be? And typically lenders are looking for they're looking for two things. They're looking at the debt service coverage ratio, the DSCR,
Okay.
and they're looking at the loan to value. And so for a commercial asset like this, lenders are typically fine going up to 65% loan to value or loan to purchase price.
Okay.
But what we've seen the last couple of years in this higher rate environment, typically loan amounts haven't been constrained by the loan to value, but rather the debt service coverage ratio.
Okay.
And so that's going to be interest rate driven. And so I have here 6.5% interest rate. That's, some lenders will quote a rate as a spread over the 5-year treasury, or, depending on the term of the loan, where 6.5% is probably a good rate expectation on this.
Is that kind of what you're seeing right now in the market is around 6.5 or?
Yeah. I mean, there's some lenders that can get in the high 5s or low 6s for certain assets. This one, it's a single tenant metal building, which is fine. But it's not going to price the same as, a Class A apartment.
Okay.
From that standpoint.
So interest rates on Class A apartment are probably what? High 5s?
Yeah. So like if it's an agency loan, or is probably close to 5.5% right now, whereas a bank could probably do a high 5% rate. From that standpoint, so if I was taking this to the market, I would probably ask for a low 6% rate, 6.25. Part of it is also, as the broker, setting expectations. I don't want to say like, oh, I can get you a 6% flat rate and then come back with 6.5, right?
Yeah.
I'd rather tell you, hey, 6.5 is probably what we can get done. Go to the market and see if I can get you 6.25.
Gotcha. Okay.
So plugging in a 6.5% rate and then a 25-year amortization, So, is a good opportunity to just talk about how loans for commercial real estate are structured versus, I'm going to assume most people are familiar with a mortgage on a house, typically, let's say a 30-year loan with a 30-year amortization. It's self-amortizing, so we don't even think about it differently. Some people do a 15-year mortgage, 15-year term, 15-year amortization. In commercial real estate, it's very common to have, let's say, a 5-year term, but still have a 25 or 30-year amortization, which means you have the loan for 5 years, you're making payments as if it were a 25-year loan. And then at the end of the term, you're responsible for, we call it the balloon payment. You're responsible for the principal remaining balance. And so how does that work? Well, at that point, you're either refinancing or you're selling the asset to pay off the balance. So oftentimes for multifamily, we're looking at a 30-year amortization. For commercial properties, sometimes you can get 30. Usually it's a 25-year amortization. So that's what we're going with here.
Okay. And is the balloon payment typically 5 years, or do you see 7 or 10-year type balloons on, just call it industrial Class A properties?
Yeah, I'd say usually 5 years. I think historically 7 and 10-year terms were more common.
Okay.
But in the higher rate environment where people are expecting rates to eventually go down, 3 and 5-year terms have been preferred by borrowers because they don't want to be locked in for longer than that.
Gotcha. And are there like any prepayment penalties typically? Like if someone locks in a 5-year term, 25-year amortization, 5-year balloon, and then year 3, they're like, hey, I just want to put cash on it, or they do something different. Or is it just kind of depend on who the bank is?
It depends on the capital source. So the short answer is yes. And when we do kind of an overview of the different capital sources, I'll touch on that a bit more.
Okay.
But so for sizing purposes, 6.5% rate, 25-year amortization, and then you start plugging in loan amounts to get your DSCR. And so does it size for a $4 million loan? Nope, we're not covering at we need a 125 or a 117
Okay.
at 3.7. Oops. Okay, at 3,725,000, we're in business.
Gotcha.
And so that comes out to 61% of the purchase price is what we're saying this asset, the loan it could qualify for.
So that's basically saying when it's 1.25% or times the DSCR,
Yeah.
that's basically saying, hey, the NOI can cover the debt service, so the principal and interest, and an additional 25% on top of that. Is that kind of what it's saying?
That's right. Yeah. So thank you. The operating income from the property over the annual debt service, it's, as Matt said, 25% higher. And so that's, for a variety of reasons, to be conservative, to make sure that there's margin for profits. Certainly as the investor, you wouldn't want it to be, at least not for a permanent loan. Like in this circumstance, you wouldn't want it to be a 1.0 because then all your money's going to the bank.
Okay, cool. So in this case, it's 1.25 times the debt service, and then it's 61% loan to value. And just to kind of pause there for a second, so like, a lot of people are, like you said earlier, familiar with more like residential properties where you can get 20% down, 80% loan to value, 30-year amortization. I've even seen interest rates on like just short-term rentals or like homes, probably like 7%. So it's interesting comparing that to this, to where, you know, the loan compared to the property is definitely a much lower percentage, closer to 60 or 65%, like you're saying. But what's interesting to me is that interest rates are materially lower than what I've kind of seen on the short-term rental or the home side, but maybe that's just because the loan terms are much shorter, the 5-year terms. Is that kinda why interest rates are better compared to the market, or am I seeing it differently?
Uh, the term could play a factor for sure. Because the bank or lender, they're thinking about how long they want to be locked in at a certain rate also. So that plays a factor, or it could just be the particular lenders. I was looking at a mortgage pricing within the past month, and granted, there's been a lot of volatility, but 5.75, 6% was the best I saw from a credit union on the residential side. Now that wasn't an investment asset, so that plays a factor as well.
Gotcha, okay.
So most people, if you're seeking a loan on your own, certainly, you could call the bank that you have your checking and savings account at, or your credit union. You could make those calls on your own. There's, one of the reasons you'd go to a broker is because in theory, I, have contacts at a lot more banks and credit unions. And so some of it's just a numbers game and just being able to clear the market and go to more sources. Some of it is just market knowledge, and we're in the market every day, so we know who's competitive or who has an appetite for different assets. And then there's other sources of capital, so like life companies. So they take in insurance premiums, and one of the ways they reinvest them is through lending on commercial real estate. And so that's something you would generally have to go through a broker to have access to that kind of capital. So just briefly thinking through the reasons why we might go to one of these capital sources or another, the rate at any given time for different assets, any of them could be more competitive than the other. And so likewise, that'll impact the leverage as well. Typically, bank and credit union loans are going to be full recourse, which means that the borrower, the ability to pay the lender back is not just based on the property that they would foreclose on, but that you are personally guaranteeing that the lender will be paid back, and that they would, could come for personal assets.
Yep.
Life companies can be attractive from that standpoint. Oftentimes can offer non-recourse on this asset, given that it's a single tenant and there's kind of a binary risk there. You might be able to get limited recourse, maybe 50% recourse from a life company, but generally this is a recourse deal because of that binary risk with the tenant. If the tenant leaves, what's the backstop? The backstop is the borrower.
Gotcha, okay.
And then from a deposit standpoint, banks and credit unions, some of them have requirements. If we're going to lend you X amount of money, then we want you to bring some deposits. That's been something that we've seen a lot the last couple of years. I would say it's generally become less of a requirement, and certainly loans can get done without that requirement, but we do still see that sometimes. And then which is an advantage of a life company, is they're not banks, and so they don't need to hold your money, and they're not
They
going to
don't
ask
need
for
you to
deposit.
open up a checking account and hold X amount of dollars there for a certain amount of time for them to go borrow
Yeah.
and do other stuff with, right?
Yep.
Yeah.
And then what Matt was referring to is the prepayment penalties. And so that's the oftentimes a disadvantage of a life company, is they have what's called yield maintenance, which means, if you want to exit the loan early and pay it off via a sale, refinance, or however, they're going to make you pay a penalty and take the present value of the interest that they would have taken. They're going to calculate what the present value of that is today, that you'll also have to pay off.
Okay.
And whereas banks, oftentimes we see a step down prepay, which means, let's say it's a 5-year term. In year one, maybe there's a 3% of the loan amount penalty to exit. Year two, 2% penalty. year 3, 1% penalty, and then you're open with no penalty for the final 2 years. Sometimes you'll see a bank waive prepayment penalties altogether if it's on a sale. They just don't want to get refinanced, their business taken to a competitor. So that can be variable and negotiable. And then credit unions oftentimes don't have a prepay penalty at all, although that's not always the case.
Okay. So really, in summary, when you go broker these deals on behalf of clients, there's really three main groups you go to: either banks, credit unions, or life companies. And there's different pros and cons with each. And depending on the asset and the specific situation with the buyer, you'll go shop rates with one or more of these. It's kind of
Yeah, that's right. That's for this deal profile, the size of the loan, it's permanent financing versus like bridge or construction.
okay.
It's a commercial, industrial asset versus, let's say, multifamily. All of those things, factor into what capital sources you're going to, along with the business plan of the borrower. If you intend to sell the asset or refinance in 3 years, then we're probably not going to, put you in a loan that doesn't give you that flexibility.
Yep. So if I'm buying the property, I've got that 60%, 61% debt to value ratio of what I'm trying to secure from one of these groups out there. And I want to do a 5-year term. I don't necessarily have to pay it off early. Like who would I'm more interested in, hey, what's the lowest rate I can get? you know, like who would you recommend going to if in this particular situation?
If you're holding it for
Yeah, 4 or 5 years, through the term of the loan, and I'm really just seeking like the lowest interest rate.
If you're seeking the lowest interest rate, then yeah, you're going to shop it. So, there's some go-to banks, credit unions, and life cos, that would be interested in this deal size that we would shop it to. So, that is the
We'll
consideration.
probably shop it to all three of those groups out there.
Yeah, particular lenders that we know are competitive on rate for all three.
Gotcha. Okay.
Yeah, and that's why I couldn't really say one always has a better rate than the other. It depends.
Kind of depends. Okay.
Yeah, the lenders, just some other criteria that they're looking at. So you might wonder, like, am I qualified to pursue a loan like this? As a general rule of thumb, lenders are looking at your net worth compared to the loan amount. They want to see that your net worth, so that's all of your assets, less your debts, your liabilities. They want to see a net worth that's at least the loan amount.
So whatever equity you own is greater than that amount.
Yep.
Okay.
They also want to see that your liquidity, that's money you can access today, basically. So that's your cash and a checking account, savings account. It could be at a brokerage and marketable securities, as long as it's not subject to penalty. So, for instance, usually you're excluding retirement accounts unless you're of age to access them without penalty. So liquidity, lenders like to see at least 10% of the loan amount.
So in this case, it's 3.7-ish million loan. So really, this person would need to have probably $400,000 cash in the bank.
Yeah, I mean, at least 300,000 or 400,000.
Okay.
It's all it's not a rule, just a generalization. And
okay.
And then experience, certainly there's lenders that will lend to first-time commercial real estate investors, but other lenders are going to be pickier, and they're going to want to see that you have prior experience with this particular type of asset class. Some of the ways you can mitigate that if you're less experienced are, a lender doesn't want to see like, oh, I'm new to this. and I'm going to manage the property myself. So, if you're new to the game, hiring a third party property manager that's reputable is one way to mitigate that.
Okay.
Another way to mitigate that would be partnering with someone who does have experience.
Gotcha.
They're going to assess the property. So like we said at the outset, this is a light industrial property, which lenders generally have quite a bit of appetite for. It's a single tenant asset, which is generally considered more risky than multiple tenants, but that can vary significantly based on the financial strength of that tenant. So it's important to understand their financial condition. And then, just as you should be looking at as the investor and working with Matt on this, the lenders to varying degrees are going to look at, what's the submarket look like? How can I look at it from a comp standpoint, or what have similar assets sold for? What do other rents look like in the market? We kind of alluded to it earlier, but there's pros and cons to being, above market, below market, at market. There's pros and cons depending on your business plan, and the particular situation, from that standpoint.
So let's before we go to the next tab, let's talk about comps real quick because on the residential side, there's comps database. It's easy to get. Now on the commercial side of things, it can be kind of the Wild West. There's multiple comps databases between a lot of these brokerage companies out there. Lenders probably have their own comps too, but how are you guys going about getting comps, or are these lenders going to get comps?
Yeah, I mean, certainly we lean on subscription services like CoStar or Real Capital Analytics, but a lot of it's also relationship based. Like being at CBRE, we have brokers, we have an appraisal group. Certainly, Matt, knowing him as someone who's in the market, we're constantly talking to brokers and appraisers for that information. And that's some of the, the value of working with a broker, whether it's with Matt on the sales side or with someone on the debt side.
Yeah, and I can imagine CBRE, I mean, one of the largest firms out there, you guys probably have a massive database of comps because of all the different brokers that you guys have. So I'm sure that's a definite benefit of working with you because not only do you have all these strong relationships with these banks, but you also have a lot of incredible data to help support the decisions and the visions of what your clients are trying to achieve. So, and I've done a lot of work with CBRE, and you guys over, different deals throughout the country, and very legit, great group out there, and tons of data and resources. So, I've personally experienced it for sure.
Yeah, so that I would say that pretty much, I think, wraps up the loan analysis. We'll go to the sources and uses here. So sources and uses, that's where's the money coming from and how is it going to get used. So we recall that we sized the loan to this $3,725,000. So if we have a purchase price of 6.1, you're going to have a variety of closing costs, similar to buying a house. You're gonna have fees to brokers. You're gonna have an appraisal. You're gonna have an inspection. On the commercial side, you're gonna have you're gonna incur some kind of legal cost. But you have these other costs you want to make sure you account for the total amount that needs to be capitalized. So if you take out your expected loan proceeds, you can get an idea of, okay, how much equity, how much money do I need to be prepared to raise or bring to the table here?
Okay. And are you seeing most of your buyers today, are they raising capital to buy these deals, or are they coming with their own skin in the game?
It really depends on the nature of the deal. I would say for a sub $10 million deal, it's probably a single investor or a small group of investors that have partnered together.
Okay. So you're really not trying to go out and raise too much capital for these deals between 1 to 10 million, maybe a little bit.
Yeah, I mean, you know, that I would say that's in the realm of like friends and family money. If you're, you know, if you're trying to raise capital for this size of deal from an equity standpoint.
Okay. And I just want to maybe pause here for a second. So that's like deals between 1 to 10 million bucks where you're, going to get debt on a few million bucks and maybe raising equity on another couple million. Can you tell me real quick, like, what are some of the biggest deals you guys do? Like what range does it go to?
I mean, on the high end, I would say there's really no limit. So, I know, people in our group have closed loans over $100 million. We've closed loans that, you know, are $1 million.
So it's basically everything in between.
Yeah.
Yeah. Okay. So I mean, that just goes to show like the relationships you have and the expertise. I mean, you can kind of do anything between a million and 100 or 300 million, whatever that number is. But where are you seeing most deals on average that y'all work on, like debt side of things versus equity size ranges?
Yeah. I mean, we do a lot on the debt side in the $5 to $25 million range.
Okay. So 5 to 25 is kind of what you see a lot.
Yeah. I mean, that's, private investors or groups, versus like the institutional deals that are going to be larger than that.
Gotcha. Okay. Yeah, maybe, I know we only have a few more minutes, to talk through this. Maybe just kinda quickly walk us through maybe some of the rest of these expenses here. And I don't know if you did a cash on cash calculation, but if we have time, I might wanna just quickly dive into that in a minute. But within the next few minutes, let's just walk through the rest of this, and then we can wrap up.
Okay. So you want to take a look at the closing costs?
Yeah, maybe just kinda walk us through what you would typically see on closing costs. And are these just kind of standard estimates that are obviously could change a little bit, but just give the investor a high level of what they could expect?
Yeah, that's right. It's a high level estimate. So I mean, like the origination fee to CBRE. So that's as the debt broker. My fee is typically 1% on a deal like this. The lender is also going to have an origination fee that can vary. From a quarter of a percent to, on this type of deal, you shouldn't be paying more than 1% to the lender. Different deals with a different profile could warrant a higher fee than that. But so in this instance, I've plugged in half a point.
Okay.
Legal fees, for a $3.7 million loan, it could even be less than this, honestly. But this is probably the minimum I usually plug in. And, same with an appraisal. I put 5,000, maybe it's 3,500. And so we're stressing it a little bit here, 10,000 miscellaneous. Because, if you're the investor, the last thing would want you to do is to show up with 2.3 million and you really need 2.5 to close, right? So we're
Gotcha.
kind of erring on the side of being a little conservative, but it's pretty close.
Okay.
You have third party reports, appraisal, an engineering report called a PCA, property condition assessment, an environmental report, also known as a phase one. So these are required by the lender. Sometimes you can utilize, let's say, if your seller has a recent PCA or environmental report, sometimes you can utilize that. Other times the lender will insist on ordering their own.
Okay.
Zoning report. Oftentimes in Houston, this isn't necessary, but if you're in a different market or sometimes even still in Houston, it is required. Survey, it is really up to the title company if they approve the survey. If you need a new survey, that's an estimate there.
Okay.
So that pretty much covers it.
And then you've got miscellaneous for 10,000. And so it looks like, yeah, you're kind of underwriting it with a little bit more, not fluff to it, but a little bit more baked in so that when it pencils out with this, it looks good, knowing it could probably be improved further in multiple different areas. Because I've seen environmental reports come in at $3,000 to $4,000. Sometimes I've seen, like you said, legal fees be less than that. Appraisal sometimes be less. So that's where you're working with the investor to, hey, we're kind of baking it in, but through the process, you're working with them to hopefully let it pencil with this, but then make it look a lot better when you get to the end result.
Yeah. Yeah. And it's all invoice. I mean, all of this is invoiced at a market rate. So, just because I have a $5,000 budget for you doesn't increase the odds that that's what you'll end up paying.
Yeah. So one final question for you before we wrap up. I work with a lot of investors, and in commercial real estate, most people are looking at cap rates, and cap rates have kind of swung all over the place, especially considering where they were in 2020, 2021, where now they've gone with interest rates going up. So cap rates are kind of sensitive to where interest rates are, to where they were, I don't know, 5%, 6%, something like that. Now they've kind of creeped up to higher than that in a lot of cases because of interest rates. And I think one thing you've mentioned to me is a lot of investors or banks try to find that sweet spot between having the cap rate and interest rate at least being equal, if not having the cap rate higher. Is that kind of what you're typically seeing on a lot of these deals?
Yeah. I mean, so certainly the economics from an investor standpoint work better if the interest rate is lower than the cap rate.
Yeah.
So we call that having positive leverage versus negative leverage, which is how accretive is the debt to the return on your deal. So in this situation, depending on the return metrics you're looking at, you could make the decision that, hey, I like the way my return metrics look without any debt, and make a cash purchase. Oftentimes, people aren't in position to make a cash purchase, even if that would provide the best return metrics. And so that's where a loan like this would still get made.
Okay. And we talked about cap rates a little bit. The other metric I see a lot is cash on cash return, but oftentimes that's more focused on short-term rental investors like these Airbnb people that, buy these, residential properties, turning them into these Airbnbs. Do you see cash on cash returns come up that much with industrial or multifamily, or is it more cap rate focused?
Yeah, I think for an asset like this, cash on cash is something that you would look at. So, this isn't the kind of deal where you have like a renovation plan or anything like that. And so it's really, I'm putting X amount of money in to buy the asset. So I'm essentially making an investment and I want to get a return on it the same as I would if I was putting money in the stock market.
Yeah.
So I would say cash on cash return is a primary metric for this type of deal.
Gotcha. No, that makes total sense. And essentially, if it's an all cash purchase, your cap rate's kind of your cash on cash return because
Right.
there's no debt on it.
Right.
So in this case, your cash on cash, if your cap rate is 6.5% or 6%, whatever it is, even after you've taken it out a little bit, your cash on cash, I don't know, it's probably 2 to 3% or something like that. I'm just guessing on it, but it's probably materially lower because you've got the debt in this, but it's still making positive return.
Do we want to calculate it real quick?
Yeah, you want to show us how you calculate that?
So we'll take the NOI, and as the investor, I don't have to use the bank's NOI. We'll use the rent we expect to collect.
Yep.
Minus the debt service that we're gonna need to pay.
Yep. So that's getting your true cash flow.
Net cash flow.
Net
That's
cash
right.
flow. Yep.
So the net annual cash flow divided by the amount of money invested, which was the equity piece. So
Okay.
3.85% cash on cash return. And you can see, to Matt's point, if the interest rate was 4.5%, that looks a lot better than if it's 7%.
Yeah. So yeah, it significantly goes up as your interest rate goes down, and your cash on cash just gets even better. So anyway, this was super helpful to really just dive through all these details together, and it's just pretty wild to see like how sensitive the numbers can be with interest rates, and just how that can just drive so many different, so much supply and demand. And it really is, telling of why the market, especially on office and some of these other assets, have slowed down since interest rates have gone up. But it's been really interesting to see, man, despite interest rates being higher, multifamily still doing pretty good, a little bit of slowdown, but industrial, man, just I feel like it's just continuing to scream up. I mean, you're even seeing it in the escalations that we just showed a second ago at 3.75%. I know markets like California have kind of tapered off a lot, but I mean, Houston, Texas, industrial properties, it just seems like slow and steady, just continuing to go up, which makes it really interesting. So, hey, if you are an investor out there and you want to get into this asset class, or if you want another great resource to help you with buying these properties, man, Beau is incredible. He's got a ton of resources on the debt side of things. If you don't want to go buy your next asset all cash, you want to go get debt on it, whether it's a new purchase or an existing property you currently have. Beau and his team are incredible. They've got a ton of resources, ton of connections, and he would be an incredible resource for you. So, Beau, if people want to reach out, how can they get a hold of you?
Yeah, I'm happy to chat with anyone that is looking to get a loan for a commercial real estate asset, and you can give me a call or send me an email. If can you see my contact information here?
Oh, perfect. Yep, you got it right there.
Yeah.
So yeah, beau.brehm@cbre.com. And you've got the number right there. You may want to say it out loud just for people that might be listening and not seeing video.
Sure. I'm in Houston, but my number is 469-360-3906.
Awesome, man. Well, this was fun doing this exercise on this one asset type. Maybe next time we need to get together and we can evaluate maybe a multifamily property or something with multiple leases and multiple tenants, because I would really love to see how you evaluate that, or how the bank would evaluate it versus a single tenant property. So I'll reach out to you soon and we can schedule another one of these, man.
Sounds great. Looking forward to it.
Awesome. I'm glad to have you, and we'll talk soon.